to basically service our debt. So what has now been happening is that we're seeing, government continue to borrow to service debt. So that's really more of the concern. But if you look at the way our Eurobonds are spread out, they're spread out in terms of maturity from 2022 up to 2051. So typically what then happens is investors just look at Nigeria's ability to basically continue to repay, and they use those reserve numbers as a judge, to measure our ability to pay.
All right, great stuff. For our YouTube viewers, we're speaking with, of course, Wonuola Akambi, Head of Financial Institution Sales, Global Markets, Stanbic IBTC, is just answering the question on how Eurobond holders will be reacting to the news that my Minister of Finance, Zainab Ahmed, saying that they could use a portion of those Eurobond proceeds to pay off fuel subsidies. So any fear or worries that the next time we approach the markets, the rates might increase based on this concern?
Yes, there's always that worry. Again, anytime you come into the market, it's just like you supply more debt, right? You supply more instruments, and because you supply more instruments, that then means that people would want a better yield, than what you've previously done. Now, if you look at the general yields, for our Eurobonds, you see that they've basically gone up, and that's largely due not to our concern, but if you look at other emerging market peers, you've just seen a bit of weakness across emerging market peers. Ghana, for instance, we've seen that weaken so much, and again, and it still goes back to what I was saying. If you look at Ghana's debt versus their reserves, their debt is really more than their reserves. So investors are more concerned about Ghana's ability to pay. So in terms of Nigeria, I think what we should be more concerned about is the rate hike in the US, right? Yesterday the Fed already signaled that they're going to do more multiple rate hikes. They did 25 basis points yesterday, so we expect them to do between another like 5 to 6 hikes in 2022 alone, and maybe about another 3 in 2023. So if you look at all of that, that would definitely add to our cost of borrowing. And Nigeria we're quite aware of that, and that's why we did a lot of issuance last year. One would have thought they would have done it before the rate hike comes in, but again, the way the market really reacts is all those things are already sort of like priced in. But yesterday it was a bit of a surprise. I think market had just priced in about 4 hikes, but now people are now saying, oh wow, we might have 6 hikes this year and another 3 next year. So definitely it's going to increase the cost of borrowing.
Now, right. Thanks, Ron. Kayode, go right ahead.
I was going to say that now we're live on YouTube, so you can leave comments on YouTube as well. So we're going to be reading your comments there. And if you also have questions for Wonuola, you can send them to our WhatsApp platform, which is 0809-444-0981.
Great stuff. So Wonuola, we're in the final month of the first quarter of 2022. How would you describe our fixed income and money market space so far in Nigeria?
Well, that's largely been driven by liquidity in the system. So if you see how we started the year, we got huge liquidity in the system from bond maturities, bond coupons. At one point in January, we had, about over 1 trillion naira in new liquidity coming. And you see bond yields compressed massively by over 100 basis points. And we saw that trend sustained in February as well. If you look at the bond issuances, what they've been doing in 2026 bonds and 2042 bonds, they started 2026 started the year in terms of stock rates at around 11.5%. Now they're trading at about 10.15%. Just to give you the significant compression, and that's largely due to the liquidity we've seen in the market. Obviously, I think when I was here last time, I also gave that view that first quarter we expected that moderation in yields. Same thing with treasury bills. We've been seeing that sustained compression in yields there as well. You even had an auction yesterday, and you saw where the 1 year closed at 4%. So we continue to see that compression in yields. However, if you now look at what the government is also looking to do in terms of look at our deficit currently is about 7.4 trillion. Right, that's our budget deficit. So that then means that people expect that the government will borrow more. And like I said earlier, when they borrow more, it's like they're supplying more bonds into the market. And as they supply more bonds into the market, that mops up liquidity. And as continue to mop up liquidity, interest rate starts to basically, widen. So we expect that to start to happen around the second quarter. I still expect this month to close strong. We still have coupons coming in this week, and we expect that all that will support the bond auction, that we're having on Monday. Now, just to quickly touch on that, we have about 75 billion on offer for 2026 bonds and another 75 billion on offer for 2042 bonds. Now, our expectations around those bonds are like probably it closes around 10.15 to about 10.3 on the 2026s and 12.65 to about 12.8 on the 2042s. Now, we continue to definitely expect that they'll sell more, and that's been the trend. They basically just sell more than what's on offer. I mean, the deficit is large. I'm not sure we'll do much for revenue. Look at what we're doing again. We added a supplementary budget in about 2.5 trillion, just for fuel subsidy. And one could argue that, if the sustained crisis between Ukraine and Russia continues, the subsidy figures would definitely have to sort of like go up. And what does that mean? I mean, our debt service to income ratio continues to widen, and it gives us lower capacity for capital spending.
Excellent stuff, Wonola. Thank you. And then, folks, remember, you can send emails, call me at stanbicibtc.com, because every time Wonola is on and he talks about money market and fixed income, there's always somebody sending me messages saying, how can they get involved? So is for anyone wanting to participate, are these still viable investment options, Wonola?
Like I always tell people, you can only buy what you see, right? And again, we're in a very low interest rate environment. Now, if you look at that versus inflation, you see, yes, you're having a negative return. But I would always say these are like what we call risk-free rates, and that's the reason why you see that banks put in a lot of their liquid assets, in all these instruments, treasury bills, bonds, and all of that. You will see a few corporates do that as well. What I would always tell people is keep it short, because again, we expect rates to start to widen in the second quarter. So I usually tell investors to keep it short, but again, because of the liquidity in the system, we continue to see banks, buy those short-end bonds. Look at the 2023s, 2024s, 2025, and 2026 bonds. We'll see massive compression down. We expect banks to continue to sort of like buy those. But like I always tell investors, like, you have what you want to do with the funds. Are you investing for long term? Are you investing in the short term? What's your expenditure profile? Do you want to use those investments to match those expenditure profile? If you have dollars, I will always say, continue to buy euro bonds. We've seen good decent returns, especially in Ghana. I mean, Ghana euro bonds, were yielding over 15%, on the 2026 and 2027. Wow. And that's like dollar return, right? And our view is that we don't think they will default, even though that their debt issuance is more than their reserves. We don't think they will default. It's more catastrophic to default because there's what we call a cross default. If you default on one, it's deemed that you defaulted on others. So and you can't really come back to the market. So there's a lot of talk that they're going to like an IMF program where IMF lends them money and everything. I know that all those come with a lot of conditions. But yeah, I mean, like I would say if you've got dollars, do some Eurobond investment, and keep it short as well. Because obviously the way the world is, I mean, you're expecting rate hikes, and typically what happens during rate hikes is that we see there's what we call risk off sentiment, right? Meaning investors tend to sell more risky assets and go to safer havens because they're getting better yields there. So you start to see that sort of like happen. So it's always good to just keep it short. But if you have long-term expenditure needs like school fees and all of that, then you can keep it long. Use your coupon process to match your expenditure profile.
Fantastic stuff. So you guys, you've heard it again. Call me at stanbicibtc.com. I am very interested in those Ghanaian euro bonds yielding $50. So holla at Stanbic if you want to get advice on how to put your money where it needs to be so you can make some cash. Kayode, are we out of time already?
Yes, we're totally out of time, but
and I had so many more questions for Wonola. Wonola, it's always It's always a pleasure having you. Really, really appreciate it whenever you come on here and you break these things down for us. Once again, Wonuola Akambi, Head of Financial Institutions, Sales, Global Markets at Stanbic IBTC. It's a pleasure. Kayode, I appreciate
It's a pleasure having you guys. Shout out to you, Wonuola. Good to meet you again.
Always good to be here.
All right.
Have a
Take care,
good one,
guys.
Cheers.
You too. Okay, Lagos, there's more to come. If you want, like Rotus mentioned, he said